Steve Kenny. I am the Commercial Director at Square Mile, and on behalf of my colleagues at Square Mile and ESG Clarity, a warm welcome to the fourth chapter of ESG Pathway. This is the fourth and final event in the series of events put together by Square Mile and ESG Clarity, and is designed to be informative and provide practical guidance. In the previous sessions, we have heard how advisors are dealing with embracing sustainable investing within their business. We've also heard from Jess Foles from the Investment Association on how they are working with asset managers to ensure there is a common language framework and consistency within the industry in terms of funds. It is therefore with great delight today that we have three senior members of Simmons & Simmons legal team: Harold Glander, Catherine Weeks, and Daniel Lumen, to provide a regulatory perspective on what is quite a complex subject. They will be talking about the distribution of investment funds in an ESG regulatory framework. This session will be interactive, so please do take the opportunity to ask questions, and we will look to get through as many as possible. To test the system's working, can I please ask that you give your opinion on the prospects for your business in 2021. Are you optimistic, cautiously optimistic, neutral, or concerned? And I'll share the results presently, so please do vote, okay, just to check the system's working. Following the session from Simmons & Simmons, we have Ask the Expert. 3 advisors have submitted pre-recorded video questions that will be answered by the experts from Federated Hermes, Jupiter and Elgin. That will then be followed by the platform perspective. We have James Dolby from the investment propositions team at Aviva, who will talk about how platforms will deal with the challenge of providing advisors with the information on responsible investing. And finally, we have the asset manager panel. We have 3 superb representatives from the asset management industry. This session will be chaired by my colleague, Jock Glover, COO from Square Mile. We have Aegon, Steve Jones, AXA, Chris Igo, and Newton, Andrew Parry. They'll be answering the question, what will future funds look like? What are your predictions? And finally, to wrap up the session, Natalie Kenway, the editor of ESG Clarity, will provide a quick roundup of the key points from today's session. Some housekeeping: the event is being recorded. The event does qualify for CPD. I would encourage you to take part and submit questions both to the Simmons & Simmons team and to the asset management team. I would, finally, before I pass on, like to say a quick thank you to our 12 sponsors, 6 of which you'll be hearing from today: 7IM, Aberdeen Standard, Aegon Asset Management, AXA IM, BNY Mellon, Federated Hermes, Invesco, Janus Henderson, JP Morgan, Jupiter, Elgin, and finally Schroders. On behalf of myself and ESG Clarity, many thanks to these sponsors. Without their support, this event would not be possible. I will now pass over to Harold, who will kick off the presentation from Simmons & Simmons. Harold, over to you.
Good morning, everyone. And first of all, thank you, Steve, for inviting us to speak at this session. Thank you to Square Mile for organizing this. It's really a pleasure to be here. My name is Harold Glander. I'm a partner in the financial services team in our Frankfurt office. So in the last few months, almost over a year now, we've obviously been dealing a lot with regulatory questions in relation to the EU ESG regulation. So we need to be brief, I was told by Steve, so let's jump right into it. If we look at the agenda, we will first, in the kind of first 15-20 minutes, set out the regulatory background. So you will hear a European voice with a very German accent on with me and Daniel on the ESG sort of EU framework. Hopefully that fits well. And then for the distribution issues in particular, for the UK, Catherine with his expert knowledge of the UK distribution market. Hope that fits in neatly. So if we look on the next slide of the key drivers for EU ESG regulation, there's a few of them, but only let me pick out one or two. First of all, if we look at the Fridays for Future Greta Thunberg movement, but that's well understood, but there's also a shift in the generations of decision makers and of investor profiles. So the Greta Thunberg of today, or the Greta Thunberg fan of today, might well in 10, 15 years decide about billions of dollars of investment. So we need to take this into account, and the ESG regulations actually only kick off or follow from a regulatory perspective this trend that has also been kicked off from a social and investor demand perspective. Secondly, well, COVID-19, you can't miss the word Corona in this year, of course. I mean, this has definitely fertilized the need of social and government considerations. We now have a vaccine. We had a pandemic. No one thought this could ever be like this. How we are dealing with the next one. This will definitely also be a driver of ESG considerations for the future. Data, just to say, I mean, it's a problem. Everyone knows that when we look at the disclosure regulations, but I think these things will be overcome over time. We have a specific driver and impact, Catherine, that we actually in this time also can't really deal without.
Brexit.
Yes.
So the Harold and Daniel asked me to come and speak today on this, because I think we can't ignore the fact that Brexit will have an impact, an immediate impact on the implementation of the EU package of reforms that kick off next March. And I would expect that many on this audience have SFDR implementation projects running within your business. And one of the key questions within that will be, to what extent do I need to implement as an UK firm? I don't want to prejudice that decision that you've arrived at internally within your organizations, but the reality and the way in which the onshoring of EU rules have happened this year and will happen next year means that certainly the current package of reforms, including SFDR and the delegated acts and the taxonomy, will not be implemented into UK law. We are taking a snapshot of law. It won't be a Brexit discussion, a snapshot of our law as at the end of this year. And we will be implementing all of EU regulation and EU changes that happened during 2020, but not during 2021. There are certain packages which the UK are onshoring. Next year, we're seeing IFR-AFD that will be onshored and followed, but SFDR is not. So as a matter of UK law, there will be no UK law that maps to SFDR next year in March. Fully expect that there will be something coming, but as a matter of law, there isn't. And while that sounds great, many of you work in organizations that are highly complex. You cross-support European businesses. So it's not to say you can put it in the back burner, but I just thought we would frame the discussion so that you kind of at least have that in mind, that when Harold is speaking, it's a question of actually deciphering the extent to which that will then impact you as a business. And we'll talk a little bit further on that when we talk about the distribution. Is that okay for now, Harold?
Absolutely. And I mean, before Daniel takes over and talking about regulation in general, I mean, from a bird's eye perspective, this is obviously the biggest package of EU regulation that's coming in after Brexit, and something where there'll make likely be a divergence between the two regimes, which is, I mean, generally a quite interesting trend. But without further ado, we're here to talk about SFDR. Daniel, if you want to dive right into it.
Thank you, Harold, and thank you, Kathleen, for setting the scenes. So on this slide, we would like to give you a brief overview of the European ESG regulatory framework, which starts on the level 1 regulation requirements. We have level 2 and some sort of level 3. But to start on level 1, the most important And new regulations which has been introduced in the ESG framework is the taxonomy regulation, highlighted in green on the top of the left side of the slide. And on the right-hand side, you see the SFDR, which we will describe in more detail at a later stage. So let's have a look at the taxonomy regulation. The taxonomy regulation is part of the action plan of the EU Commission, which has been published in March 2018, and the European Commission issued in May 2018 a proposal for a regulation to implement a taxonomy for ESG requirements. The agreed level 1 text for the taxonomy regulation has been published in June 2020, so this year, and the regulatory or the framework regulation, as it is also called, established a classification system or a taxonomy to provide businesses with a common language to identify whether and given economic activity should be considered environmentally sustainable. This in turn will allow the companies in scope, but also third parties, to determine how far an investment is environmentally sustainable, or let's call it green. The Commission considers this necessary because the range of interpretations by member states, but also by market participants as to what counts as a sustainable investment was very broad. And so the Commission tries to figure out and to establish one common understanding. In overview, an economic activity will be considered environmentally sustainable, where it contributes sustainability to any of a series of defined environmental objectives. So we have 6, which are also set out in the taxonomy regulation, does not significantly harm any of the environmental objectives, complies with a series of minimum requirements, so the ILO requirements and social safeguards, and compliance with so-called technical screening criteria, which will be developed as a level 2 measures. And currently or recently, there have been issued proposals which counts as up to 500 pages for level 2 measures. On the right-hand side to the taxonomy regulation, you see the SFDR. We will come on the next slides a little bit more detail to it. Just to mention that the level 2 measures for the SFDR has been postponed, so they will not be effective as of March 2021, but we will discuss this a little bit later. Most importantly, for the distribution angle, we have the changes to the level 2 measures of MiFID II, the Users Directive, IFMD, but also for the IDD and for the Solvency II. IDD and Solvency II we will not cover in this session today, but Catherine will set out the requirements for the amendments to the level 2 measures for MiFID II, in particular the sustainability suitability criteria in the distribution process. The taxonomy or the SFDR is applicable for financial market participants, but also for financial advisors. These are 2 new terms which has been introduced by the SFDR, and financial market participants are defined as companies such as AFIMs, users management companies, but also credit institution or MiFID firms who are providing investment, who are providing financial portfolio management services. So in essence, companies who manage the money of other people. On the right-hand side, we have the financial advisors. These are companies or defined as AFIMs, UCITS management companies, but also MiFID firms and credit institutions who are providing investment advisory services. In relation to, and this is also new introduced, the financial products. Financial products are defined in the SFDR as AFEs, UCITS, but also managed accounts within the meaning of the MiFID II. On this slide, we would make now the deep dive into the SFDR and provide you with a broader overview of the structure of the SFDR and to give you a little bit or to provide you with an understanding what requirements or disclosures have to make starting from March 2021. As you can see on this slide, we colored it a little bit and tried to make it for you more easily to understand what information via what channel you have to disclose starting from 2021. At the top of the slide, you see which companies are in scope of a disclosure. On the right-hand side, so in the middle of this this slide, you see the content of each disclosure, and on the right-hand side to the content, you see the level which is targeted by this disclosure. So we have the company level and the product level, and this is one of the most important decisive factors if it is a company level disclosure or product level disclosures. On the right, you see from which day you have to disclose the information. So most of the information have to be disclosed starting from 10th of March 2021. And then you see on the right-hand side of this slide if the disclosure requirements are supplemented by level 2 requirements or by the taxonomy regulation. As said on earlier in this presentation, the level 2 requirements on disclosures has been postponed. So you, as a financial market participant or financial advisors, are not required to meet the criteria in the level 2 RTS from March 2021. As the Commission has confirmed that the disclosure requirements will be applicable at a later stage. So currently there's a little bit of uncertainty from which date you have to disclose or have to meet the criteria as set out on the level 2. But the level 1 disclosure requirements are not affected by this, as they are applicable from March 2021. To give you a little bit of detail, we have the product and company level disclosures, and the company level disclosures starts from Article 3 to Article 5 of the SFDR. The most important and most discussed disclosure requirements are Article 3 and Article 4 disclosure requirements of the SFDR. Under Article 3, you are required to disclose information on your sustainability risk policies. These are related to the value of the process of the investment decision process. And under Article 4, you're required to, if you decide to comply with this disclosure requirement, to provide information on the adverse sustainability of your investment decision processes. This relates to the values of your investment decisions. Article 5 relates to remuneration policies and have to be disclosed, as you can see from the key at the bottom of this slide, via your website. So the company level disclosures have to be disclosed via your websites. Starting from Article 6 to Article 11, you have the product disclosure requirements. And as you can see from the presentation, there's a distinction between financial products which have an ESG focus. So this is Article 8 to Article 11. And you have disclosure requirements which are for all financial products, including the ESG focused financial products.
Daniel, just to chip in here, I mean, you know, on the next slide, we will sort of go into the details between Article 8, 9, because that will be also very, very important, Catherine, from a distribution point of view, because this will definitely be a decision-making point at the point of sale, yeah. If we look at the transparency requirements under on the company level, what we also need to take into account is Article 4, because Article 4 is going to be very detailed disclosure requirements for adverse impact on other sustainability criteria, other adverse impacts on other sustainability risks. That means you need to disclose information on a company level, not only about the investments of your the risks in relation to your investment, but also whether you take into account in the process any other sustainability criteria. So just to set an example, if you invest into a real estate domicile just located at the sea, you take into account the sustainability risks, the rise of the sea level. That's Article 3. However, if there's emissions from the real estate into the sea, you want to pollute the ocean, that has to be taken into account under Article 4. So there's a long list of criteria on that under level 2, and we won't go into the detail. And there's also for smaller companies under 500 employees a comply or explain mechanism, where those who do not wish to make these disclosure under Article 4 can explain why they don't do that. However, what we've seen in various projects here is that, I mean, at least the larger managers, well, they're compulsory over the 500, but also those a little bit of larger size would not choose to opt out of Article 4 simply because of investor demand. And we will see that when Catherine talks about the distribution, this is a trend driven by investor demand. So it's unlikely that we will see lots of managers opting out of the Article 4 disclosures, at least not those operating on a larger scale. If we go to the next slide, Daniel, just to round it up as far as the differentiation between Article 8 and 9 are concerned. I mean, Daniel already set this out quite neatly. I mean, we have disclosure requirements in Europe, meaning the rest of Europe, not the UK, because the rules will be decisive, will be fully applicable from March onwards for all products. That means you have to disclose whether you take into account sustainability risks on the product level or not. And if not, you have to explain that. So all products basically need to be amended from a documentation point of view if they are still distributed. There's a sort of the specific questions, of course, in these sort of projects where you say, okay, what about projects that are not distributed anymore, that are closed and so on. But these are all, let's say, specific questions that we come across in our daily advice. But then there's a pyramid of two other sort of categories of ESG products. First one is Article 8. So you have a product that is advertised. Yeah, it is advertised with sustainability criteria. So you have a fund that follows, let's say, a specific ESG benchmark, has it in its name, and obviously the marketing material will refer to it and say, well, this is great if you want to sort of take into account special sustainability criteria, then you could invest or can invest into this product. This is Article 8, and Article 8 as a consequence says, well, if you say that, if you market it, you need to also to fulfill additional criteria on disclosure level, because the intention of the regulation is not to make it compulsory to for investors or for distributors to have ESG products, but it's basically anti-greenwashing is the magic word here. It's basically to prohibit that you can say you're doing ESG without putting flesh to the bones, without walking the talk. Yeah, so you need to make on product level disclosures how you want to fulfill these criteria. And now to come on the top of the pyramid is Article 9, so-called impact investment products, where the product provider sets for a specific goal, an environmentally or sustainable goal. Yeah. For instance, my investment objective is to make investments into companies that clean the ocean or that reduce the pollution of the ocean, to stay in my example earlier. So here again, information requirements, how in the pre-contractual disclosures, how do you intend to fulfill this goal? How do you want to meet this goal? And I mean, coming to what Catherine will allude to later at the point of sale, obviously this can also make sort of a difference when you are as a distributor wanting to explain what the products have in their as their preferences. And if the investor says, well, I only want to have an Article 8 product or Article 9 product, then obviously you must choose from this basis. Of course, for the UK, taking Brexit into account, there might be nuances. If we go quickly to the next slides, and this is probably, I'm not going to talk about this, why the UK has left Europe is simply because of the level of detail we just very, very briefly set out here. But I mean, Catherine, we're very, very looking forward to what you say, what is likely to come on the UK instead of it. Maybe it's worse. I mean, you never know. On the next slide, just before I hand over to Catherine, we'll see a brief extract of Article 10. What's Article 10? Article 10 is a completely new requirement of information for products, Article 8 and 9 products, where the product provider needs to sort of have an additional disclosure on their website. It's not the annual report that's covered under Article 11. Also in the annual reports, information on the product and how the sustainability preferences and so on should be dealt with. But here you have an additional disclosure on the websites where well, the product provider needs to put, again, to make it short, flesh to the bone, how they want to achieve their sustainability goals. And I mean, of course, the investors can review that. There's potentially on all of these disclosure levels, there's a civil liability risk abstractly. I mean, obviously, it's always a case-by-case analysis, but as lawyers, of course, we need to make the statement that, I mean, if you don't fulfill your regulatory obligations and contractual obligations, there is, of course, a risk for civil liability. Maybe pausing here, conscious of time, and handing over to Catherine now.
Thanks so much. Just checking I'm not on mute. Thanks, Harold, and thanks, Daniel. I want to talk a little bit about point of sale within the UK today. So I think there'll be a mixture of people that will be, selling in the UK, and there'll be a mixture of people who are making products to be sold within the UK. I think Harold and Daniel were talking a lot about actually the products that are being put together. If you're actually selling in the UK, the question is, what does this mean for me? And really all SFDR, because really that's the big bow next year. All that is disclosure. So really SFDR is saying to people, you make whatever product you want to make, but you need to tell people what you're doing. That's really what it is. Tell people what you're doing. Now, for a UK distributor, we spoke earlier about the Brexit impact. The immediate lay of the land next year is that no change yet. Now, we know that the UK has been a big proponent for the green financial economy. It wants to be seen as a leader. So I would say for you that you are very much, if you're very much a UK firm, this is not a kind of a pass card. This is just a temporary relief for we'll see what will come. Now, the regulatory lawyers, and particularly within Simmons, where we've a cross-border practice, are kind of, well, maybe a bit cheeky to say in one way, but it would be so easy if it would just map to the EU regime. We're now quite familiar with it. If we just had the EU regime, we'll just map the project across. The slight subtext here is that the UK may want to show its teeth. Now, well, whatever the deal will be, we'll see, but it's now viewed to Europe, saying a financial services rule that's an EU compromised in EU 27 text can never really achieve what we believe on our own that we can do. So there's likely to be a kind of a temptation to go down a slightly different line. In essence, it will be similar, but it will be slightly different. And I'm just saying that because the complexities we'll see emerging for big EU regime following one route, UK route following another route, and us having to navigate between both of those. I think the premise is right now, a little bit of reprieve for very UK siloed firm, but it will come and we'll have to see what it will come like. That said, what are the Europe doing, I think, which would be interesting at least to see. So that might give a direction of travel of how that will affect the UK firms. And the big change coming that will affect kind of at the coalface of the distribution is changes to the MiFID suitability test. For those of you that are advisors, you'll be very familiar to run your suitability test. And in effect, with your retail audience, you're ingesting what they want. And you as a firm are saying, okay, thank you for that information, different sleeves of information. And I as a firm need to determine if what I'm offering you is suitable. Within the current framework, there is no obligation to question or ask people about their sustainability preferences. So in other words, being really crude about it, are you a good citizen or are you not a good citizen ultimately? So what's going to happen with MiFID at the end of next year, we don't have a firm date, and what we'll see in mainland Europe is an obligation on those firms that are under suitability obligation, advisors or discretionary managers, not platforms, but advisors and discretionary managers, is an obligation. As part of that, suitability done in onboarding, but it will clearly have to be adjusted for your kind of annual reviews or your regular reviews. A question to investors: what are your sustainability preferences? That's quite defined, what that result is. And ultimately, you're asking people, do you want an Article 8 or 9 product? And back to what Harold and Daniel were talking about earlier, firms and product providers, the big behemoths in Luxembourg and Ireland, will be categorizing their products into 8 or 9. And so in other words, if you have a client who says, actually, I'd really like 8, actually, yeah, I think that's where I want to go. And we've had the Greta Thunberg and the youth changing. And if they want an 8 or a 9, you have to give them an 8 or a 9. And so you need to have systems in place where you can ingest that information. Well, European distributors will have to have systems in place and processes for the ingestion of that information from product providers, be able to distill that through their systems, ensure they're delivering out. If you give them something that is not, well, if you give them something that's not, you won't be, you're giving unsuitable advice. There's a regulatory breach. And also you want to be sure that what you're getting from the product manufacturers really are an 8 or a 9. 9s aren't causing too much trouble in the markets. 8's where we're getting a bit of the risk, because from the product provider perspective, I shouldn't be jumping to the end. A lot of people want, certainly on the sales desk in the business, want 8's. The legal and compliance team, senior managers are a bit nervous around 8's because there's a big spectrum. It's quite grey. And then we can run into the whole greenwashing risk and systems. But from you, for those of you that are financial advisors on the call, just be mindful that it is very likely that you will get to a point where you will need to ask your audience, what do you want? And you'll need to provide that. I also thought I'd just take a moment for those of you that aren't aware, but you'll probably be quite used to ingesting the EMT, which is the European MiFID template, which is the kind of the data set that throws product information around the market. They're currently at the moment, there's a working group to set up an extension to that. So we're going to have an EET, which is going to be the European ESG template, which will be the data document set that product manufacturers will have to fill in to give information. Now, They don't have to. There isn't going to be a regulation or a law says you have to fill in the EET, but the likelihood is that is what will be used. So you might want to start following that. You might want to the working group is closed, but you can get information. So you may want to just tag on to that and find out what's happening there for product information. As UK firms, you'll be getting that information anyway, because I presume a large part of your book will also be Luxembourg and Irish funds. If you've got ETFs on your platforms, you're likely to be getting that information. It is very likely you won't be getting that from your UK fund range. As a house in the UK, you decide what you want to do with that information yourself. You're not going to be under a regulatory obligation, immediately to do anything with that information. But I think it's worth at least being cognizant that you will be getting it. Even if it is a question of you saying, I don't, necessarily want to do anything with it. So I really think it is just for those of you that are selling products, the message is current reprieve. We are expecting something to happen in the UK during the course of next year, and particularly when we've got Biden coming in, we certainly would see developments in the market. How they will journey, we'll have to see. The direction of travel in Europe is suitability. It's being attacked through the suitability route. We are seeing product manufacturers seeking to match that demand by creating 8-9 products, either creating them fresh or adjusting product sets to fall into these buckets. And we will be seeing them being pushed through the distribution market. I think just be mindful that the 8s will come with a spectrum. 8s will be a big spectrum of very, very light touch, products on a screened out basis, products on a kind of an allocation basis. I don't think we'll have time to go through. We could really unpick the weeds of what an 8 is, but I think those of you that are financial advisors will need to know that, because you need, 8s come in a massive guise. And I don't think the test is going to be as simple as, do you want an 8? Here's an 8. It's what type of an 8? What kind of are you anti, are you a bit categorized and saying young person, but, do you want to avoid are you want to pro-renewable energy? Do you want to avoid certain categories of industries? So all of that is very complex, really, and really financial advisors are about returns and just achieving returns. But there will be a big shift for those at the mindset and how you're selling. So mine was a little bit less kind of the legal, but I just wanted to give a flavor to you that the changes will come. And it's interesting for us as regulators, because we really like rules. We love rules. Just give us the rules and we'll do the rules. But actually, this is far more complex than rules. This is a real business shift and business change, and it can't be run in an organ. This project can't be done by legal and compliance delivering a set of rules back to the business. The business need to be engaged very early in this and journey with it, because it's really going to be a big shift for you on the business side of things. So that was really kind of how I was going to cover the distribution on the point of sale in the UK. I don't know whether
maybe to chip in, Catherine, what you absolutely neatly set out on the MiFID II requirements, because those will, for the time being, first of all, definitely continue to apply in the UK, right? Because it's an existing regulation that is on short to the UK. And level 2 amendments obviously come with it, yeah. But the current suggestions already say that if a investor chooses, as you say, sustainability preferences, you are only allowed to offer him only certain Article 8 products, because you say the range can be quite broad between Article 8, because actually Article 8 is we only advertise it, yeah. So you're only allowed to sort of offer Article 8 product with a certain impact, which is a quasi Article 9 product, or those who, and this comes a bit later in the regulation from a timing perspective, who make these principal adverse impacts on a product level. So it limits at the moment the space. Yeah. I have heard though from various associations here in Germany, I mean, I'm sure you heard the same in the UK, that the Commission is sort of considering to narrow that down, which is, I mean, narrow down the sort of widen the scope of the products. Actually, that means the products that can be offered. Then you still need to ask for the sustainability preferences, but it's not so close that you only can offer those two products. But that is going to be determined. The next draft will likely be the final. I just wanted to add that.
That's a very good point. I mean, I think and that's going back to the point of those of you at the point of sale, in terms of those of you giving the advice, you kind of need to understand what is in my armory, what have I got on my book that I can offer, and does it match? And to Harold's point, I said Article 8, he's right, it's actually a subset of Article 8, and so it actually is even narrower again, and that might shift. And for the product providers, the big shift in, as we were talking to a client recently, you don't want to be Kodak, you don't want to get left behind. So it's that real tension of making sure you have a suite of products that match. But again, the point about this is all disclosure. It's not just getting it over the line for the day one, it's the life of the product.
Absolutely.
It's close to the whole life. So actually it's a shift. It's a change. The PMs at the coalface making the decisions need to understand it. So you can see the kind of complex thread running through the whole industry. And it's quite remarkable that it's just disclosures, but it's really showing that this is driving by the need, the underlying investor client demand is shifting this, which is an interesting.
And the investor demand is not only retail, right? It's really driven by institutional. I mean, I'm representing one of the advising here constantly one of the largest European German-based managers, and I mean, if you see, I mean, if they look into, I mean, what products do you want to invest in as a fund of fund in the future? If they get asked by clients at the moment, fund managers that have their products that are the target investments, they would say in some instances, obviously depends on the fund of fund, but they would say, well, if you're Article 8 or Article 9, I think we're fine. Yeah, it doesn't exclude all the rest, but I mean, it gives a, as you said, direction of travel. Yeah, and I mean, that goes obviously down to the retail space. Steve, I'm conscious of time. Catherine, did you have additional points? Because I mean, I know you have some additional slides, but I think you covered actually everything on this one slide.
Yeah. Well done. So a couple of quick questions. The SFDR, as you quite rightly said, is all about disclosure and is not applicable to the or not coming into effect in the UK. However, as you quite rightly said, a number of the audience will be actively utilising non-UK domiciled vehicles from Dublin or Luxembourg. What will be the obligation on them in terms of the information produced by the manufacturer, the asset management business? Do they have to take that and pass it on to the client? Or is it sufficient that they receive it? Where does their responsibility lie?
We'll forget about the kind of cross-servicing, which you can there will be a contractual commit. You're likely, if you're a UK large house, to get caught contractually, but forget that, limit it. If we're talking about point of sale, I mean, right now, they will be, you're right, Steve, they will be getting information because the big houses in Luxembourg and Ireland will be putting it on their website, putting it in their prospectus, putting it in their EMT that they're sending out. I mean, strictly speaking, there won't be a rule in the UK which will say you need to consume that data point and tell the end investors. Now, I think more broadly, one component we've been talking about also earlier on is risk. So there's two limbs of SFDR. Is there anything that's going to happen from a sustainability that will affect the value of my investment? And the second is, how are my products how am I deploying the assets in such a way that I'm being a good citizen? So the values, certainly that first limb, if there's going to be an adjustment of the risk. So now you're going to be told, actually, the chance of return here is, quite affected by sustainability. I think as a fiduciary, you should be consuming that information. In terms of whether I'm a good citizen or not, there isn't strict rules that will say you need to be disclosing that to your clients. Now, some advisors might want to get ahead of the curve and may want to start thinking and talking to their underlying clients and saying, what are you interested? What do you want? But I think that's a decision within a house to kind of go that step ahead. But they won't have right now, in any event, won't have a set of rules which strictly say you must consume that and disclose that.
Right, cool. And one of the questions, whilst the SFDR is not coming into the UK, from your discussions with the asset management community, do you see UK only houses, so businesses that do not have a Dublin or a Luxembourg range, adopting this almost as good practice, as seeing it as a best of sort of endeavours, particularly when they've got other businesses from Europe or businesses with fund ranges actually lodged in Europe producing it? Do you think we'll see groups in the UK adopting it by choice rather than necessity?
It's the decision people are going through now. So I certainly don't want to prejudice and say everyone's doing one thing and everyone's doing another. I think the tensions are self-imposing rules which you're not subject to. You're not subject to. So how will a board decide and be comfortable to adopt a framework where there are other rules, but no rules within the UK to point to? How will that be policed? Slight tensions on, are we backing Treasury and we're backing the new UK regime, or are we kind of saying actually we'd rather hang our hats on the European regime? But there's also the tension of we know this is, probably jumping to the kind of an obvious conclusion. This is the new way we're going to have to do business. Unless I'm a tiny, very specialist kind of advisor that's looking for value in a different way. But if I'm relatively broad based, this is how we're going. So do I actually want to go early and be ahead of the trend? Do I want to capture the market early, sometimes first mover advantage? So I think all of those decisions are where people are trying to get to. In any event, if you do decide to implement partially or fully, it's just an internal decision. There will be no kind of formal external policing of that.
And one of the questions was, whilst we've got this on the horizon and it's not coming to the UK, what sort of time frame do you sort of expect the UK regulator to consider this? Is this likely to be in the next couple of years, or is it one of those things that will be manana? It'll always be next year, and they'll hope that the industry adopts it.
I elegantly sat on the fence in your last question, Steve. So I kind of now I'm trying to see how I can sit on the fence on this question. I don't think so. We're going to be looking to try and get a trade deal with the US. If we had seen Trump retain it, I think there may have been more of a scope for time on this. But I think if we see the kind of vaccine working, we've seen COVID start to fall down the kind of priority list for Q1. We see the Brexit land kind of settle. I think Q1, we're still going to see quite a lot of airtime being absorbed by sorting out the Brexit, particularly if we go out hard. And COVID. But I think once that settles after a few months, I think this is really top of the agenda. We've already seen Rishi Sunak talk about the green bonds. We've seen that commitment that they're giving to the market. So I think it's a temporary kind of reprieve for March. But 2021, we will see something. The FCA have said they're going to consult, and there will be a consultation process. So I'm not saying we'll have hard formal rules in 2021, but we will certainly, I think, during 2021, have a very clear indication and clarity on how the market will move in the UK. But I could be wrong.
Cool. And just a final question before we wrap up. You've talked about Article 8 and Article 9. If I was to ask you in a couple of words to summarise to the audience, what would they be looking at if they were looking at an Article 8 fund and an Article 9? And I know, Harold, you said that it's such a broad definition, it's hard to do that. But if you could just give us a couple of words so the audience.
Yes, I think that's actually not too difficult. If you look at the top of the pyramid, Article 9 has a sustainability goal. Article 8 is marketed with sustainability criteria. That's it in a nutshell. And if you do not, and that's quite important, obviously the devil is in the detail and nuances, but that's what we're lawyers for, differentiation if it's an Article 8 product at all. If you have certain exclusion criteria are not marketed, then of course you need to decide whether this is it is an Article 8 product of all. But just to say, I mean, this is a case-by-case analysis.
Yeah, I think Steve, you would have traditionally been the temptation that 9 would be more the impact funds. Now, I'm not saying impact funds meet the definition of 9 now, that because they were created before SFDR came about, but I think there's certain intention within product providers. Those impact funds would be the ones you would more tend to see up on that 9 or moving up into that 9 bucket.
And the new ones definitely need to meet the criteria.
Yeah.
But the old one won't meet them.
Yeah, 8s are those that are that have a good citizen element to them, and then the question is, what is that good citizen kind of component? And they are the trickiest ones, and they'll be the trickiest ones for the advisors, because you have people pushing in at either end of the spectrums, particularly those ones that are pushing in, and that's the greenwashing challenge. Am I saying I'm an 8, but I'm not really, and am I going to get into a lot of trouble in the long run by all the litigation funders who are lining up ready to put their money at kind of big class actions? And we know them, and they tell us that they're ready with their financing for this. So that the 8s will be the kind of come with the health warning.
Cool. Well, that's been a fantastic session. So I want to thank you, Catherine, Daniel, Harold. Thank you for joining us today. That's been really informative, very useful for the audience. So thank you very much. I'm delighted to say now we've got a session called Ask the Expert, where we have Jupiter, Legal and General, and Federated Hermes experts answering questions from IFAs. Thank you.
What happens to the existing range of your funds if the industry moves wholeheartedly towards responsible style investing?
Firstly, we'd welcome such a move. We have long been championing the idea that capital markets have an important role to play in enriching investors, benefiting society, and preserving the environment, something we term sustainable wealth creation. We believe that these 3 stakeholders are intertwined, and that essentially we can all win from a move towards responsible investment. As it relates to our fund range, we recognise that there's a segment of the market that invests according to morals and values, and in doing so, require thematic tilts in their fund exposures, both via hardwired exclusions and positive impact from portfolio companies. That said, when you buy any Federated Hermes fund, you will always get a fully ESG and stewardship integrated product, regardless of whether it has sustainable, ESG, or impact in the fund name. We would therefore argue that any Federated Hermes fund has a high degree of sustainability and could sit under the responsible investment banner. ESG is placed in equal importance to traditional portfolio management metrics, an approach I believe is unparalleled across the industry. Companies operating in the so-called sin sectors are uninvestable for us unless we have a high conviction that we can deliver meaningful positive change via our stewardship efforts. At the heart of our ESG approach is stewardship. When stewardship is done well and is properly resourced, it has a crucial role to play within responsible investing. Exclusions and positive impacts of course have a place, but we believe that driving positive change in businesses with below average ESG profiles that are willing to embrace change will have a material benefit to the stakeholders mentioned previously. In short, we'd welcome a wholehearted move and could practically embrace it tomorrow.
Hi, my name's Adam Lewis, and my question is this. ESG and responsibly invested funds have seen significant inflows in 2020. Do you expect this to accelerate next year and beyond?
Yeah, it's true. More clients are selecting dedicated ESG products, but I think perhaps it is worth reflecting the growth we have seen was off a relatively low base. Momentum was building or starting to build ahead of 2020, with demonstrations and movements becoming increasingly prevalent across the world, both on a climate-related basis, but also on a social. And what the pandemic has unveiled with a sharp wrench is elements of fragility within the economic framework that has been built. You know, we are in the midst of a worldwide humanitarian crisis. Global poverty progress has been set back by a decade. We have seen pockets of eye-watering unemployment, with the most marginalised carrying the heaviest toll, both in terms of fatalities, but also economic impact. We've seen race and gender inequality ignite social unrest. And on the climate side, we know that if we're going to get even close to a net zero outcome, we need to pick up the pace. And yes, for sure, you know, the pandemic has accelerated that rate of change. There's no question of that. But the landscape is changing much quicker than we anticipated. And our sector is not alone. We see it across industries, from how we purchase goods to how we deliver our work output. We know viruses like greenhouse gases care little for borders. And there is clearly momentum behind what other actions can be taken on a collective basis. And when we think about our own industry, it is clear that there is a role that our savings can have in addressing the balance of broader stakeholders. So the planet, people, and profit. And integrating ESG enables us to consider this when making investment decisions. So where does this leave us? We have an increase in products, an increase in client demand, legal, regulatory tailwind. So yes, we anticipate continued and meaningful growth. In effect, ESG has become accessible for people and their savings. And for us, my team and I have decades of experience navigating the landscape of sustainable investing and ESG integration. And therefore, we think we're in a strong position to help align our clients to addressing these increasingly urgent issues. We have gone to great lengths to demonstrate how their savings have supported broader stakeholder need through a really thorough annual impact report. This is key in helping clients understand why the integrity of our decision making is so important when investing in companies on their behalf. Authenticity is key. And as you would probably expect from an active, high conviction house like Jupiter, we think this gives us an advantage in an asset class that is open to subjectivity, or perhaps worse, tick boxing. For us and how we run our Global Sustainable Equities Fund, it's very clear those companies that address the needs of planet and people are in a better position to deliver profit. And to understand a company's opportunity, we don't just look at what it sells, we look at how it operates. As if this is going to be a scalable option for the industry, we need to offer diversification. And the current momentum has never been so compelling, certainly not in my investment career, which has been entirely dedicated to managing sustainable funds. And going forward, I think it's clear capital markets have an opportunity to deliver a more regenerative form of capitalism that enables broader value creation. Our clients, both current and future, clearly recognise the importance of their own savings in this evolving landscape. And we're really pleased to be here to support them on that.
How do you think reporting on responsible investing will evolve? And what do you think might be included?
Yeah, no, sure. This is an incredibly evolving area. Now, investors no longer necessarily measure success purely just in terms of risk-adjusted returns. Now they're looking to achieve additional goals, like from a societal or an environmental perspective, which is kind of why we've seen billions of dollars now flow into funds where ESG objectives are fully integrated. However, this dual objective approach that we're now seeing come through more prevalently requires an ability to obviously demonstrate success and evidence success when it comes to an ESG perspective. And this is why we're seeing responsible investment reporting really come to the fore now. But I guess unlike financial reporting, where the outcomes are often quite binary in nature, where you've either underperformed or outperformed a benchmark, when it comes to ESG, you often have to digest multiple metrics to come to a conclusion as to whether an objective has been met. And I guess to complicate matters even further, the data alone doesn't necessarily tell us the full story. And we often actually see a disconnect from a pricing perspective in the market and an ESG rating. And I've got two great examples of that, being Tesla and Exxon. So if we take Tesla first of all, and look at its outperformance since May 2019, and then we compare that to its MSCI rating from an ESG perspective, it's remained a constant A. However, if we then look at Exxon, which has significantly underperformed the market over the same time period, its ESG rating has too remained constant, but at a triple B. So for us at Legal and General Investment Management, we think that scores have to be used very responsibly. And in addition to that, we go one step further in adding a qualitative judgment and assessment as well. And this is because we want to build a holistic picture of a company. We don't necessarily just want to understand where it's been historically. We want to have a grasp on where it's going into the future. Now, when it comes to responsible investment reporting more generally, look, I definitely think standardization is going to come into force. And arguably, we're already seeing that, be that through the likes of the TCFD or SASB frameworks. In addition to that, we're obviously seeing a huge tailwind come through from a regulation perspective through the likes of the EU taxonomy. Now, I think when it comes to this standardization effect, the one thing to remember is that it's going to be dynamic, it's going to be fluid, and one size doesn't necessarily fit all, which is why I want to leave you with 3 things to remember when it comes to ESG reporting going forwards. The first of those is momentum. Now, as I've already alluded to, the discount mechanism in markets isn't necessarily pricing ESG risks fairly. So when it comes to assessing a company, look for progression, look for change. Don't necessarily look at just historical data. Second of all, it's challenge. Be prepared to challenge investment managers. If you don't think an ESG objective in a fund is being met, or you're unsure as to why there's a single holding within a company to a company in a portfolio, what is that characteristic from an ESG perspective that you're looking to actually capture within that fund? Be prepared to challenge on that basis. And last of all, it's imperfection. Imperfection at this point in time is better than inaction. As I've already alluded to, this is a hugely dynamic and fluid area of change. And I think there's going to be more change going forwards. But utilize the metrics that are out there now to build a better understanding of the ESG characteristics in your investments.
Thank you. And now, just before we go on to the final video from Aviva, I'd like to ask a question, and the polling question will be coming up on your screens presently. Having heard the regulatory update, do you feel better informed? And there's 3 choices: have a better sense of the regulations now, still confused, and reaffirmed what I already knew. So if you could indicate that. And I was delighted to see that so many of you are optimistic as we look forward to 2021. Now, having heard from Simmons & Simmons about the level of material that is going to be required to be passed down to you as advisors from asset managers, it becomes increasingly important to understand the role that the platforms will be playing in this particular situation. Given the vast majority of the investment business in the UK is transacted through platforms, their role is going to be incredibly important. I'm delighted to say now that we have James Dalby, part of the investment proposition team at Aviva, who's going to talk through how they intend to deal with this particular challenge. Thank you. Over to you, James.
Hi, I'm James Dalby. I'm part of the investment proposition team that supports the Aviva Advisor platform. Really pleased to be here with you today just to share some of my thoughts and some of the thinking we're having at Aviva around ESG and where we're going in the market. Okay, so I haven't got long, so I'm going to cover briefly five areas. So depth and breadth of ESG, the regulatory outlook, the customer advisor research that we've done recently, what I think the role of platforms is, and then a sort of a wrap up, a conclusion. Okay, so although ESG isn't new in itself, the rise in its profile over recent times has highlighted a plethora of terminology: green, impact, sustainable, positive change, climate, etc. Many other terms associated with that. And one of the problems with that is that some of these terms can be used interchangeably and incorrectly. And the upshot, I think, really is that we as an industry need to make sure we're all educated against a consistent standard so that we can meet customers' needs clearly and with a clear articulation. There's lots of work being carried on by the trade associations and member bodies to help define a common understanding of ESG, and of course providers like ourselves and service providers like Square Mile are all part of that debate as well. I'll also point out that there is a fairly detailed good practice guide due out imminently from the Investments and Savings Alliance, TISA. I've seen a draft of it. It's going to be very helpful, I think, for people who really want to get into the detail of ESG and understand the various aspects, the regulation, how best to communicate with customers. And importantly, that's going to be available to all and free of charge via the TISA website, and that's imminent. So the regulatory outlook, I'm not going to say too much on this because I know you've got other presenters who will get into more detail around the regulatory position, but I have to touch on it, it's really important. So we know that the UK government matches the ambition of the objectives of the EU Sustainable Finance Action Plan. So change is definitely coming. And although there's been much uncertainty through 2020 over the UK's position, particularly around the implementation of the EU Sustainable Finance Disclosure Regulation, or SFDR, but also the MiFID II suitability regulation changes. It's now clear, and certainly in recent weeks, it's become very clear that the UK is not working strictly to the EU rules or timetable, and that's really because Brexit affords the UK an opportunity to take stock and implement something that is fit for our market. And also importantly, when the UK government introduces legislation, the FCA will consult on any changes to the handbook. So we'll all get an opportunity to feedback on that consultation. But it doesn't necessarily mean there'll be massive divergence from the EU, but it could certainly include some tailoring, particularly where customer-focused improvement opportunities exist, and that we identify as an industry. The FCA, through a recent speech given by Richard Monks, Director of Strategy, has outlined that it's thinking about providing some guiding principles around ESG product design and disclosure. My view is that this is very welcome, and I think it's really important that, as an industry, we help the development of those principles and feedback on any consultation opportunities that are offered to us. And the final point I'll say is, as much as the regulatory change that will come is important, it's also important to know that, or understand that, the regulatory or the mandatory developments really need to work in conjunction with discretionary proposition development activity. The two need to come together and work together, really to give the best customer outcomes and make the most of ESG as a topic. Okay, so Aviva recently commissioned some detailed customer and advisor research into ESG, and that's really to help shape our thinking and shape our proposition development roadmap for the advisor platform. So 5 key takeaways. You may not find these surprising, but I think it's really good that we ground some of our views and thoughts in hard research. So at the moment, we see it as advisors rather than investors who are driving the agenda on ESG. Advisors very much expect there will be customer-led demand coming, but even for advisors at the moment, the level of ESG business that advisors are currently managing means that it's not the most significant part of their business. That may change over time. We've touched on, the second point is we've touched on already, terminology. It's a real issue, largely due to its subjectivity. We found that the term responsible investing was seen as user-friendly. But under the ESG umbrella, we also found that environmental rather than social or governance issues are more prevalent, and there's more interest around them. And I think there's an opportunity for us to do more as providers, to provide more help and guidance around the social and governance aspects. Climate clearly is very important. It's had a really high profile through the news over recent years. And actually, it's an area where the regulator and the Bank of England, the Treasury are focusing a lot of time. you will also see them follow through with more on social and governance over time. I'm certain of that. Third aspect of the research that we took away was that the real challenge for advisors seems to be, one, pinning down the customers' wants and needs in this space, but also when that's done, matching those preferences to, you know, the ESG funds that are most appropriate. There are problems around inconsistent rating systems, fears around greenwashing, and investors also expressed their views with us that they share that concern and that challenge as to whether their preferences can be met by you know, investment funds that are in the market. The fourth area is that there is a real strong desire for support from the financial advisor community. The level of information that's desired really ranges from basics to, you know, simple videos, webinars, right through to having a dedicated ESG hub, really to help advisors build confidence in the topic and enable them to engage with clients. You know, you should start asking your providers what they're doing in this space, and you know, whether they've got ESG hubs building and that sort of support. It certainly is happening in parts. There needs to be more of it, would be my view. And the fifth and final point I want to bring out is that we found that both advisors and clients felt Aviva was well placed to launch a wider awareness campaign for ESG and more specific support. And you know, that will be true with other providers as well. So the role of platforms. The first thing I should say is you should expect platforms to play a significant role in the evolution of ESG and your use of ESG with customers. And as a minimum, I would highlight a few things. Firstly, you should expect us to be contributing to Treasury and FCA consultations, and I'm sure you will be as well. You should expect us to incorporate future mandatory changes, including disclosures in the core transactional journeys, and including, you know, advisor training to support you with those changes. But when it comes to funds, you should also expect us to facilitate a wide range of funds and discretionary investment manager solutions with various degrees of ESG-ness, if you forgive me for using that term. So, for example, I'm thinking there from embedding ESG principles or ESG optimization in mainstream multi-asset funds, right through to impact funds that have a primary focus on a specific ESG-related topic. My general view here is that we don't want ESG funds to be seen as something that's abstract and separate to the mainstream. We need to see ESG as mainstream. There will be different degrees of ESG-ness. And, you know, there's nothing to stop you starting now if you're not already talking to your fund providers about the degree to which they're embedding ESG into existing mainstream solutions, as well as, you know, clearly noticing the you know, more specific types of funds, the climate type funds, the impact type funds that are starting to emerge. I think you should also expect us to build on the mandatory changes with discretionary upgrades, which I talked about earlier. So things like supporting the financial advisor research and selection process and ongoing customer reporting. And I think you'd expect that consistent with a platform's role as a service provider and a key part of the value chain that you know, works for the customer and you as FAs. And the final point I'll make here is that I think ideally the company providing the platform should be able to demonstrate strong corporate ESG credentials. And it's great to see propositions themselves exhibit those credentials, but I think it's better if the company behind the propositions, the funds, the platforms, can also demonstrate those credentials in how it operates as a business and the sorts of things it does as a corporate entity. So, conclusion. The topic of ESG is deep and broad and interesting, I hope, to most of you. The regulatory position is evolving, but it's clear that the UK government and the FCA are committed in this space. We're seeing financial advisors already increasing their engagement with ESG and the use of funds. and there's no real reason to wait for future regulation to get deeper into the topic of ESG. Research is absolutely key to the development of propositions, I believe, and giving the right customer outcomes. Platforms will play a big role in supporting the overall solutions that FAs can put to customers, alongside fund providers, of course. And just to reiterate the point, financial advisors are not alone on this journey, and you really should seek out the significant support and training that's available from the providers and trade and member bodies. So look, that's it from me. It's been great to be with you. I hope you have a great rest of the event today, and hope to see you again another time.
Thank you, James Darby from Aviva, for those insights. And good morning and welcome to the Asset Manager panel. This morning, we're focusing on the evolution of responsible investing and on funds of the future. I'm Jock Glover, I'm hosting the panel. I'm COO of the Square Mile Research and Consulting business. And in order to help me in this endeavour this morning, I'm delighted to introduce an extremely eminent panel of speakers. Chris Igoe, who is the CIO at AXA Investment Management, Stephen Jones, who's the CIO of Aegon Asset Management, and Andrew Parry, Head of Sustainable Investment at Newton Investment Management, which is part of BNY Mellon Investment Management. This session is also an opportunity for you to ask the panel questions over the next 40 minutes or so. So please do feel free to submit your questions or vote on other people's questions and move them up the priority list on the system. While you're formulating any questions that you might have about responsible investing, the evolution of it, and the future of funds within that context, perhaps I'm going to start by asking a question. I've recently heard the period of 2008 to 2020 described as the age of improving the world while making returns. Do you think that truly reflects what investors think and asset managers are trying to do? Chris, maybe if we start with you.
Yeah, I do. I think asset managers, investors are always trying to make returns, but increasingly over the last decade, other non-financial considerations have come into the thought process. So there has been a much bigger emphasis on ESG, on the development of sustainable investment strategies, investors thinking about how they can allocate their capital to make an impact on social progress and the environment. And of course, we expect that will continue and even accelerate in the next 10 years.
Andrew, is that how you see things over at Newton as well at the moment?
Well, undoubtedly, I think investors have seen environmental and social considerations as a lens for better understanding the full picture of an investment, better understanding where the world's going and the set of transitions and changes that are influencing our investment lives, but also business life and our sort of daily social lives. I think also we need to reflect on the fact that in that 12-year period, we've still seen global carbon emissions rise. We've now transgressed, I think, 4 out of the 9 planetary boundaries. We have challenges still around issues like Black Lives Matters. So, while we're all claiming a lot of virtue, we still should see that the hard work is still to be done. And we have to think of it as going beyond a mere label and thinking about how do we actually transition and transform the actual system, not just the way that we think about our portfolios.
Stephen, how do you think about it at Aegon?
Well, we've certainly been harvesting impressive investment returns over the last year. I mean, the annualized yearly return on US NASDAQ is 20%. But even if you've just got a broad exposure of fixed income and bonds closer to home, then you've made 5-6% per annum quite easily. So there's definitely been return to be had. I'm a bit like Andrew in that I am skeptical about the notion that we've really improved the world. So in that process, in that last decade, the last decade has been the hottest on record globally in terms of temperatures. 6 of the last, 6 of the hottest years the world has seen have been in the last 6 years. The incidence of natural disaster has clearly increased over the last 3 decades on long time frames of observation. On the social front, there are still more fund managers called Dave than there are female fund managers, even in our own industry. So there's a whole equality, inclusion, and diversity agenda still to be tackled. And even in areas where we think we have got a good record as an investor community, as the fund management group, that of governance, then there's been plenty of scandals, Patisserie Valerie, Wirecard, audit failures, BP Maconda, the issues around, copper and tailing dams in mining, Rio's own indigenous population type issues, and even boohoo and labor abuse and supply chain abuses, all failures of governance over the recent past. So I think we've got one side of the equation right in harvesting the returns. I think we've got a lot more to do in terms of improving the world.
And just talking of the world and the returns, you touched on the returns that we've had over the last 12 months, which have been driven by the US. And we've just had a session with Simmons & Simmons, listening to the change of regulations that are coming into effect across Europe as of March. The US is much further behind, some would argue, in terms of the sort of responsible investing in ESG, etc. Is the change of leadership in the US going to change that? And is that going to continue to drive certain US stocks and therefore the wider markets, do we think?
I'll kick off, but there's lots of observation to be made around this. I personally think that it will, although you have to put in context the change in presidency and the executive against a balanced and divided Senate, and not as much of a majority for so much radical change, even in the House of Representatives after the election in the US. I think there is a lot going on in the states, and actually it's quite often being led at state level. So, California would naturally be a place to go for strong sort of environmental and impact regulation and activity, but that's beginning to be mirrored by many other states in the US at a more local level. And those regulations and doing business in those jurisdictions will be impacted as they become bolder and more prevalent across the US, I believe.
Andrew, what are Newton doing to address the change of leadership over in the US and how that might or might not impact these sort of funds going forward?
Well, I think it's an interesting observation to start with is that even under the Trump administration, renewable investment in renewable energy was at a record level. Why? Because it's good economics, and that's something that we shouldn't lose sight of. Is the cost and efficiency of renewables with battery storage that become a story of the future has just made renewables now a sensible economic choice. And in America, they always like making good economic choices. Now, I think the Biden administration will accelerate that. I think it's interesting it's coming at a time when China has signed up for zero carbon for 2060, when Japan and Korea have signed up for zero carbon for 2050. So, we've got the change in the presidency, 180-degree reversal in attitudes coming at a time when there's this incredible shift politically towards decarbonizing the world. Now, there'll be backsliding. They won't all do it as effectively. But the key thing is that this is a powerful trend. So if China's to make, for example, its decarbonization by 2060, I think renewable demand will increase over 17-fold. So these are really big structural opportunities that are going to endure. and really are going to accelerate as the economics of scale really begin to kick in, and then with the addition of technology enabling an acceleration in that transition.
That almost leads into a question I was going to put to the panel about the impacts on those sort of stocks that might benefit from those changes we're talking about here. And what I was going to ask was, in the context of coronavirus this year, you've seen responsible stocks doing very well as a result of them being, healthcare and technology, which is sort of what you're talking about to a degree there. Whereas some of the more traditional areas of the market, where industrials and energy sectors, etc., have struggled over the course of the last 12 months until more recently, where you've had a bit of a value bounce. Chris, do you think that that's going to continue then? So we're going to, the recent bounce we've seen is just a little blip in those older industry type sectors, and what we would expect going forward as the US, China, Japan, etc., move towards carbon neutrality is more of the same that we saw for the bulk of this year?
I don't know. I think you have to distinguish between, the cyclical movements in the markets and the secular themes. And obviously the whole digitalization area is a long-term secular theme that's been strengthened by the changes that we've had to make to our working and social lives this year. But I do think that we're on the brink of maybe a golden age for more traditional industrial companies that are able to benefit from the energy transition. If you look at some of the things like hydrogen, for example, as an alternative fuel, the key players in that market are all European industrial companies who are, to some extent reinventing themselves, but taking advantage of new market opportunities. And the technologies involved lend themselves to those parts of the economy. It's industry. That's where the expertise sits. That's where the science sits. So things like carbon capture and improving battery life for electric vehicles and things like that. I think that's going to be led by what we would traditionally call the industrials. And I think Europe has a opportunity to be a leader in that, because some of the early work that's been done is being done by European companies. So I think that, in a way that digitalization has really been a mark of American dominance over the last decade or so. I think the carbon transition allows Europe to kind of catch up a little bit in terms of market performance, but also we'll see contributions from China and elsewhere.
Stephen, where do you see the opportunities within that context?
I think that it's a major investment theme that people ought to, recognise and allocate capital to, aside from the, moral imperative to do something about the state we're in. And that is, very powerful as well. I see it as the next decade as really offering the opportunity to knit some of these technologies together. I think some of the activity to date has been quite sort of siloed or point focused. You were tackling a particular aspect of climate impact or social policy or governance. I think what we're moving to now is systems that can elevate and improve whole areas of our economic and social fabric. So I am, looking at something that's going on around Glasgow, whereby renewable wind power is going to be used to correctly and in a non-industrial way catalyze water to produce hydrogen, which then goes into the public transport network, and the retooling of that into a more carbon-friendly fleet of vehicles in the greater Glasgow Strathclyde region. Now, you begin to see that sort of joined up looping that not only has an environmental benefit, but also a huge social benefit. It more localizes and stabilizes supply of power and use type chains. And I think you're going to get that in spades over the next decade. Definitely pump primed and inspired by, the disruption we've had year to date, which kind of reminds us that it's not just the pure economic pursuit of things that's important. It's about resilience and other factors, whether they be environmental or social.
Andrew, you've been in the responsible world for a long time. Do you see that's a similar theme, or do you have a different take on it?
Well, I think Stephen's perspective of the system change is so vital. It's really important, because that's what we are. We probably have a decade in which we must and probably can transform the whole system of production and consumption of energy production. So it's a really exciting transformative period. I think the one thing we always have to remember that we're still investors, and that we have to think about where in the sort of value chain the value will accrue. And what worries me a little bit at the moment is there seems to be a crowding into a limited number of what might be called solution providers. They tend to be very highly rated. They tend to be that point business I think Stephen talked about, and they've commanded incredibly high valuations. Now, what I'm really getting quite interested in is, I think the point Chris made, is that those companies then taking those solutions and transforming their business models. Now, not all of them will survive. We are going to go through a period of classic creative destruction where many business models will not come out of this intact. But those solutions are going to enable the companies, sort of the everyday companies, to transform their environmental and social footprint as well. So I think that's where, especially, that we should begin to think about the opportunities, particularly as we have this very bifurcated market between companies trading at quite moderate valuations but shunned because of maybe the externalities, and those trading because of a bright, shiny label at very elevated premium. Now, stock picking is always about finding the winners in amongst all of that. And I think there are going to be some really interesting names that are transitioning, changing their business models, and recognizing that removing a negative externality from their business model is removing a risk premium and actually exposing themselves to potentially higher growth areas. So, I think about televisions. Television started in 1930 or thereabouts with the BBC. In 1936, we had 200 million televisions globally. We now have 2 billion. Now, as a manufacturer of televisions, you don't make very much money out of it, but there are lots of different components and parts of that television value chain now that make a very healthy, very dynamic rate of return. So I think it's a good analogy. Just because you have growth doesn't mean the company at the forefront of that is going to be the one that always accrues the best value.
That's, I think, a really interesting way of thinking about it. And it sort of possibly leads on to a question of, if we have these companies that are in transition, etc., what does good look like? I think is possibly a way to put this question, because you're going to have, big energy companies that are investing enormously in alternative things, but they're still fossil fuel producers at this moment in time. Chris, how do you think about that from a responsible point of view in terms of putting that into your guys' portfolios and making sure that they're doing what they say they're doing?
Well, what we're all trying to do is capture the future value, isn't it, as an investor? And I think we have to recognize there's a lot of hard work to do in terms of analysis on a company by company basis. So one thing we're working on, for example, is looking at the science-based targets for carbon reduction, which would allow at the sector level and the individual company level to be compliant with a 1.5% temperature target. Now, I think we'll see big improvements in transparency and reporting at the individual company level, but it allows us to build a framework where we can analyze how that company is doing in real time relative to those targets. That's good in itself, but it also allows you to make comparisons with peers and focus on the best-in-class performance. So that's just one example in the carbon field. I'm a bond guy by training, and I've spent most of my time looking at fixed income markets. What we're doing on that side is looking at the risks, the ESG risks. So trying to materially focus and measure the risks on all of the ESG factors, and again allow the portfolios to steer towards those exposures with the lowest risks.
So within your portfolios and your team are running, ESG is more of a risk factor and something you want to make sure they've considered across the piece, rather than it being an add-on or something that, like the old-fashioned exclusions or something, if you see what I mean.
I think it is. Certainly fixed income, we would see it as a way of understanding risks. Now, we run a lot of institutional fixed income portfolios where, for pension funds and so on, who don't have very low turnover, when they invest in a bond, they want to make sure that that bond is money good and doesn't deteriorate over time. And we look at it through the traditional credit lens, but also increasingly through an ESG lens to try to identify where those ESG risks are. On the equity side, it's much more about opportunities. It's much more about impact. It's much more about trying to focus on the new technologies.
Thanks.
Steve, I think Chris's point is really important. Steer towards was the phrase he powerfully used there, and I think that there, in amongst the enthusiasm and the focus that we are putting on this as an industry, in terms of returns, especially on the equity side, and very solid good stories, there is also a need to be realistic about how we deal with what I would term the necessary but increasingly undesirable. You cannot turn a carbon-based global economy on a dime. And indeed, we cannot take the disruption to our everyday lives and our employment and tax bases and our sort of infrastructure and fabric of society if we were to do this too quickly. There has to be urgency and speed about it, but it has also got to accommodate a transition and a journey from capital allocation and continued support in some cases from things that, as I say, are necessary but perhaps increasingly undesirable, as well as just going after the hot new stuff, which, as Andrew said powerfully, some of which will fail as well and might not be quite what's all promised up front. So I am an advocate for focus on this, but also a bit of balance. And there will be areas of the market, and maybe energy is one, where there'll be some oil and gas companies that'll always be oil and gas companies, and you'd want them to do as well as possible in managing that risk and their profile in the context of an oil and gas industry, that is still vital and useful to us for the next 2 or 3 decades. But you can't just say, I'm not going to go there and cut it off, because we can't take that disruption and change.
And that's really the difference of what we're talking about here. ESG and responsible investing aren't the same thing, are they? I mean, yes, they can overlap, but Andrew, perhaps you'd like to elaborate on that, because I think that's one of the problems that people have in terms of thinking about responsible investing, ESG. It's all the terminology, everyone interlinks it all, and actually they're not the same thing, are they, from your perspective?
No, and this is a real challenge for adoption, I think, by people of ESG. Is that it's not a thing, it's not a tangible object that you can pick up and define. Our view is it's a complex series of environmental, social, and governance inputs into all investment decision making, whether it be bonds or infrastructure, equities, public or private, and without the knowledge of the material, environmental, social, and governance risks and opportunities, how do you have the full picture to make a sensible, well-informed investment decision? Now, so we don't label our funds ESG. We describe our approach as integrating ESG into the fundamental assessment of investment opportunities. Now, sustainable investment, I think, goes further, because that is where you seek to emphasize those companies where sustainability is integrated into their business model. It's part of the attraction of the business model, where they don't, and avoiding areas of significant harm, so areas with negative externalities, because they represent a potential risk that can become internalized into business models. So think about online gambling. I was listening to Radio 4 this morning, and there's talk of the gambling laws on online gambling tightening up in the UK in the new year. So, it's that, because that's interesting, because online gambling is illegal in half the world. So, if you think of a negative externality as a potential risk, that is something that in a sustainable fund that you probably place greater emphasis and greater value on and seek to avoid, and then try to reinforce those companies that are on a journey to sustainability. I think sustainability is not something, as Stephen said earlier, that we've achieved today. It is a future aspiration, it's a journey. And that for me is the excitement about sustainable investing. After 35 years of being a bottom-up investor, it is a way of illuminating where the world's going and not clinging to where the world's come from. And that's part of the art of managing transitions. And I think going back to the previous debate, when we are looking at businesses in transition, it is about the art of the possible, because not all companies will be able to profitably make that transition. There will be barriers to exit for many of these industries. So it is all about, that the business model is the way we tend to think about it. Look at it through the lens of what companies are doing, not just what they're reporting. And that will give you a much better understanding of the quality and durability of the investment.
The comment you just made about looking at how companies are doing what they're reporting maybe is a good transition to a question we've just had from one of the attendees, which is some portfolio managers are estimating mathematically the impact of responsibly managed portfolios. Is this simplifying ESG too far, and might data mislead? Who wants to have a first go at that? Stephen, do you want to have a go at that?
I think this is an incredibly difficult area, and it's one that is going to radically change over the next 3 to 4 years, and one where, frankly, there is no settled yet view about how to produce a fully sort of comparable set of metrics about a broad range of activities that a company or an investment opportunity might represent to you. There's a lot of regulation going to come down the pipe. The SFDR process will kick off in 2021 and force the industry, us as investment managers, to be a lot clearer about the profile of the funds and the impacts and investments that are within them in a sustainable ESG type categorization. There's going to be a lot of work done about not just carbon, but overall environmental intensity and damage. And I think it's a bit too soon, really, to say how that is going to settle in my mind. I do think in that journey there will be quite a bit of sort of reversal stroke. Well, that's not quite as important as or useful a metric as we perhaps thought it was going to be, and that does put a lot of emphasis on the fund assessors and us as an industry to fully explain what our activities in this area really are, what's important to us and the strategy, and try and find and promote that to a matching set of sort of investors, and make sure that you've got alignment here, because I think it will be some time before we've got a unified, simple scoring dashboard or system that works effectively.
Chris, what do you think of that?
I'd agree fully with Stephen. I'm a bit sceptical about ESG data and scoring, but I think it's been a necessary step on the road to mainstreaming responsible investment. But I look at the market today, and asset managers have developed their own methodology for their scores. Others have taken standard MSCI type data sets. I think as a fund buyer, you're confused. So a lot of fund buyers have developed their own scoring system as well. So there is a lack of standardization. And I think we will move towards a more standardization going forward. And these scoring frameworks will be kind of less important. What I think will become more important, as Stephen suggested, is asset managers developing more credible and transparent KPIs for their strategies. So if a fund sells itself on its kind of ambition to achieve a lower carbon exposure, then it needs the necessary metrics to show that, just as we show alpha and we show volatility numbers in a traditional sense.
Thanks. Andrew, have you got anything that you want to add to that?
A couple of points to that. I think, remember that at the moment, we don't have standardized reporting by the companies. So, there's big movement, IFRS, the big four accountancy firms. There's a lot of work now recognizing that we really need to get the companies reporting the data in a standardized, consistent way before you can actually get a standardized, consistent way of reporting at the investment management level. Because otherwise we are taking disparate scores, from third-party data providers who sit between us and the companies, or we have our own methodologies. But it does worry me that there is a lot of sort of estimated data that I know is trying to get the message across, but if the companies can't measure it, how are we supposed to measure it? And it is one of the challenges going forward with a lot of the taxonomies. I know clients want to see the attribution. There is, the famous supposed Drucker quote, if you can measure it, you can manage it. Well, Paul Drucker never said that. It was a chap called R.F. Ridgway who said, if you can measure it, you can manage it. But that doesn't mean what you measure is actually of any value, or if by measuring it, you do more harm than good. And I think we can sometimes get an over-obsession that by measuring something, that means we end up with a good outcome. And that's not always the case. The good example of that was used in the Vietnam War, where McNamara, the Minister of War, would trot out all the stats that America was winning the Vietnam War, and it patently lost it. So you can sometimes get lost in the numbers at the expense of the underlying purpose.
Thanks. There's been a couple more questions that have come in from the audience. And I'm going to start with one for you, Chris. How do you justify government bonds as ESG okay? Or do you have restrictions on certain governments, and what are the metrics you use when you're looking at government bonds?
Well, we do look at government bonds through an ESG prism, and there are lots of metrics that measure things like access to healthcare and literacy and so on that feed into some kind of ESG scoring. I think what's more interesting is what I expect will be a big growth in government green bonds over the coming years, where the use of proceeds is predetermined, and it's going to finance green or social issues, social investments, and governments will need to develop their own KPIs in order to ensure that their money is being used in line with investor expectations. When you look at the kind of emerging market world, obviously there's more diversification, there's more of a disparate set of scores which can feed into making investment decisions. But for the developed countries, I think this is not a big issue in choosing government bonds, but I think more interesting will be the choice between conventional and green bonds going forward.
Do you think there's any difference there, Stephen? Sorry, you were about to say something.
One of the ways I think you can do this is around using the framework of sustainable development goals, and the UN directed and agreed areas of where you would want to excel and make progress, either develop and improve in certain areas of the global economy, but also maintain and excel at even in a developed market sense. And I think that is some way of giving you an indication of you know, how good or bad your government bond might be. Chris is absolutely right, though. The green bond revolution, the sort of ring-fenced fundraising for specific projects, you know, if you can think of it like that, it's very difficult to be completely ring-fenced and directed in a government fundraising into a funding of an economy overall type metric. Might give you some comfort as well. Whether it does or not, it's going to be a big part of the market going forward. So there'll be opportunities. It depends on how purist you want to be. In an exclusion world, you know, in some of the old ethical funds, you can't buy government bonds, full stop, because of defense policy and all that then sits nastily around that sort of view of the world. And that's also an approach that I think is quite relevant. There's going to be enough out there going forward to allow you to avoid government bonds if you don't want them.
Andrew, the exclusions concept is what a lot of people think as the older way of doing responsible investing, and we've progressed forward, but there's still demand for exclusions, isn't there? Is that suggestion that Stephen's made, that you can exclude and still have a demand for products going forward, still make sense?
Well, I think, you know, there's a whole range of different types of exclusion. There's norms-based exclusion, so excluding countries that breach the UN Global Compact or that are on the embargo list because they have failed states, you know, and they're values-based, and we all have values. I'm sure all four of us on this panel today have values, but they're probably all different. So that's the problem with having a values-based exclusion. I think when you run sustainable funds, there is an expectation as much about what you won't own as what you will own. So that's why we tend, you know, to avoid heavy carbon emitters, breaches of the global compact, and areas of large negative externality, because from an investment point of view, as I said earlier, they can become internalized. I think the key thing, though, is whatever label you put on your funds as traditional, sustainable, impact, they really should be defined by the positive reasons for choice. You know, that's ultimately what, especially as an active manager, you're making a limited number of decisions to take you away from the index. So really your investment approach, your approach to sustainable or ESG, should be really framed through the lens of how it makes you make better decisions to lead, you know, to still deliver what is our primary purpose, which is good, attractive, risk-adjusted returns for our clients. So, you know, I always think if you should, you know, the test of a good strategy is if you take away the label, you carry on doing it in exactly the same way, because that's your belief as a portfolio manager, as that's a great lens for adding value to your client portfolio.
Thanks, Andrew. We've spent quite a lot of time talking about, you know, the future, what's going on in the environment at the moment, what might come up. One of the things we haven't talked about is what you, as each company, are doing in terms of both from an ESG and a responsible perspective, in terms of integrating ESG across your portfolios, but also launching new funds, and where you think that we could be going over the course of the next 3 to 5 years. And how are you addressing that with your investors? How are you making sure that that fits their needs and requirements? Chris, do you want to have a crack at that?
Yeah, I mean, unfortunately, we've been spending a lot of time recently aligning how we market our funds with the new AMF requirements in France, because we market a lot of Luxembourg products in France, and also making sure we're aligned with SFDR going forward. So that's, you know, there's a regulatory burden which does take up a lot of time. I think it's about communication, though, when we're thinking about clients. You know, it's about communicating how we look at ESG, how we've mainstreamed ESG analysis into our investment process, and developing the kind of products that we think clients are going to be interested in. There's not an RFP out there that doesn't have a big section on what you're doing on ESG these days. So there is huge demand from clients, both at the wholesale and the institutional level, to understand what their asset managers are doing. And I think over the next 2-3 years, it's going to be interesting to watch the product development to see how new strategies emerge in line with changing client demand. And there are some must-haves, of course. There is data, there is scoring, there is KPIs, there is your willingness to show in your kind of thought leadership that you're fully engaged with the ambitions of the Paris Agreement and so on. But the product development is where we will, win or lose commercially, and I think that's going to be really interesting in the next few years.
Stephen, Aegon, you've had some changes over the course of the last 12 months. How has that impacted all of this?
Well, we've globalized our business and rebranded it, but actually that has not pushed through into radically different change in our investment activity. That remains unaffected, and indeed draws on 3 decades of UK-based initially engagement with companies, awareness of ethical screening and assessment of risks within portfolios, both equity and bond. Where I think this goes in the future is more onto a global sort of footprint. One of my sort of favorite statistics is that the Russell 5000 that captures the Wiltshire 5000 rather, that captures the entirety of the US equity universe actually only has 3,500 constituents in it. So as we see M&A activity, as we see private equity involvement in businesses, as we see buybacks of equity pools that have gone on, some of the opportunities perhaps locally shrink and diminish and become a bit sort of over invested in. So I think you naturally go towards a global opportunity set around sustainability and ESG, and I think that that will push out not just from equity but into fixed income markets and multi-asset activity as well. And certainly that's where we're focusing for 2021, 2022, in that multi-asset, sustainable multi-asset investor activity that I think will provide a broad range of exposure to get the right risk-adjusted return for investors, but still with the same, with an improving ESG profile to it.
Andrew, is Newton thinking along the same lines, or are you doing it slightly differently in terms of thinking about new launches, new strategies, etc.?
So if you look at the future growth profile of our business, I would say that it's around sustainable. So we've seen a significant increase in the last 12 months in the inflows into sustainable. The other complementary side of our business is on the thematic side. I think our clients are increasingly thinking about how do they look at the world through a different lens, particularly in the private wealth side. So we're seeing a lot of focus on thematic fund ideas and around the sustainable space. And then within the core business, it's around the importance of engagement, being good stewards of other people's money. And so I think our clients are increasingly demanding more engagement, more targeted engagement. So that's something we've been doing for decades. So we're happy to accommodate and push forward on that. I think then the other way is around reporting, very clear front to back reporting, because there is a challenge that it's very important that whatever you report in terms of nice statistics are actually things that you manage as an input into your investment decision-making process. And I think sometimes there's been a disconnect with what people report as a characteristic of ESG that actually isn't necessarily any evidence it's managed as an input. So we've been working very closely with our parent BNY Mellon on their ESG app, which we're quite excited about some of the flexibility that will bring us for reporting, but also evidencing, which I think is going to be a big regulatory concern. How do you evidence that you meet the requirements of the variety of different taxonomies and regulatory regimes that we all have to cope with around the world?
Thanks, Andrew. I'm very conscious of time, so I think probably we better put a pause on there. And I'll do a quick summary, I think, of some of the things that we've talked about and what has been an absolutely fascinating 40-odd minutes of conversation. But the last decade hasn't really improved the world, as I stated right at the very beginning, but there's definitely opportunities for us to do so over the coming years, and there's pressure on the investment community to help make that happen, along with probability or possibility that some of the industrial companies in Europe may well be helping to lead the change going forward. And that regulatory pressure that we heard about earlier from Simmons & Simmons will continue to drive that change over the coming years as well. The data that's out there in terms of ESG data has some distance to go before it's really user-friendly, and it needs to be more standardized for managers to be able to really use it and really understand it well. But that will require some help from the companies in terms of standardizing their reporting, so investment managers can share the data on a like-for-like basis. The government green bonds look like they're going to be an interesting addition to the armory for fixed income investors going forward. And I think ESG as a whole has been incorporated by most asset managers to a greater or lesser degree. It's slight nuances on how they do it, but it's important not to get that confused with the responsible investing in those mandates that have got specific targets such as sustainability or impact, etc. And there's a lot of activity going on across all of those houses that we've had the pleasure to hear from. So the last thing really for me to do is to thank Stephen, Chris and Andrew for their time this morning and for their insights. It has been extremely helpful, and to hand over to Natalie.
Thank you very much, Jock, and I completely agree. It's been a fascinating morning. I think the tone of this final ESG pathway of this series is that there is plenty to be mindful of in 2021, but also very much to be excited about. I mean, it has got to be better than this year, hasn't it? And the first session today, we were joined by Simmons & Simmons trio, Harold, Daniel and Catherine, who talked all things regulation, which is there is certainly a lot to consider in 2021 with the EU taxonomy, SFDR coming into force. For Europe, at least, there is still confusion about what this means for the UK following Brexit. But it is likely there will be an equivalent, and advisors should be prepared for that. Thank you to Daniel, who shared the level of disclosure requirements and transparency that companies and products will need to adhere to comply with SFDR from March. And Catherine explored the changes around MiFID suitability tests. Advisors will be required to ask, what are your sustainability preferences in their client reviews, if they aren't already, and also ensure there are systems in place to ingest that information and deliver on that. So thank you to Simmons & Simmons for taking us through such an important topic, and we were pleased to see that 70% of our listeners said in our poll they had a better sense of the regulations after that presentation. During our Ask the Expert session, Elgin Sarah Peasy shared how responsible reporting is evolving and what to be aware of when comparing data. And Jupiter's Abby Llewellyn-Waters said ESG flows will continue to see momentum amid the worldwide humanitarian crisis, and urged investors to consider planet, people and profit with their savings. Dan Churchhouse also discussed responsible style investing, funds with thematic tilts and ESG integration at his firm, Federated Hermes. Today's platform speaker, James Dolby from Aviva's UK Savings and Retirement Division, urged advisors to have a look at the ESG and practice guide from TISA and gave us 5 key takeaways from Aviva's customer advisor research. James also highlighted the opportunity for providers to do more around education and guidance for advisors. The final asset manager panel of this ESG Pathway series, hosted by Square Mile's Jock, saw Aegon, Stephen Jones, AXA Investment Managers, Chris Igoe, and Newton's Andrew Perry discuss the future of the responsible fund industry. We've just heard from Chris Igoe pointed out something which is obviously becoming clearer. Investors will be more considerate of environmental and social factors. This is a trend that will accelerate further over the next decade. Andrew Perry highlighted, however, that there is still a lot of hard work to be done in terms of labelling and transforming the system. And Aegon Stephen pointed out there are still more fund managers called Dave than any other name, indicating where D&I progress needs to be made in our own industry. And also gave examples of governance failures seen this year, reinforcing the fact that we just have lots more to do in terms of improvement. The panel also discussed the implications of the change in the US presidency and other long-term trends, such as digitalisation, something that we've all felt and benefited from this year. But Chris also pointed out we're on the brink of a golden age for industrial companies, with an opportunity for older European firms to reinvent themselves in the carbon capture and battery space. The panel also looked at the transformation in the energy sector, with Aegon and Stephen commenting that we need to be realistic about what we can achieve and focus on what is vital for the next few decades. The panel also discussed the importance of making sure companies are doing what they are reporting and the implications of misleading data, echoing the sentiments that we had in the first panel on the amount of work that needs to be carried out in the reporting and disclosure space over the next few years. If you have missed anything, there are replays on the event site, and there will be coverage on esgclarity.com as well. We are super grateful to our sponsors for supporting the ESG Pathway series and have been overwhelmed by its success. The attendance numbers have been fantastic and the feedback has been very positive, so we're all really pleased. Stay tuned for similar educational initiatives from ESG Clarity and Square Mile next year. It was great to see in the first poll of today that over 70% of you are feeling optimistic for 2021. So are we. So on behalf of ESG Clarity and Last Word Media, I'd like to wish you a Merry Christmas and look forward to supporting you and your business in 2021.